Welcome to today's webinar. My name is Andrea Armeni. I'm the Executive Director of Transform Finance and the lead convener of the Transform Finance Investor Network. I'm excited to welcome you to this discussion on responsible exits and beyond, where we'll have a chance to hear from Schiff and Hannah Dithrich of the GIIN on their recent report on responsible exits. With a discussion from Chuck Holt from InvestEco and Kanze from Grassroots. And if you're just joining us, please mute yourselves. A couple of quick updates first for the Investor Network members. We will be once again in Merida at the end of the month and at the beginning of March. Please stay tuned for a couple of announcements around gatherings that we'll be hosting while at the fleet at the end of the month. Another quick announcement: we wanted to recognize the recent podcast from Regan Pritzker of the Libra Foundation, one of our Investor Network members. Really interesting input on some of the various initiatives, including Transform Finance, that are going on around new ways of looking at what the next economy should be. So if you have a chance, check it out. We will share the slides afterwards, and you'll be able to find a link in there to the webinar. And generally, you might want to follow the Lift Economy webinar. There's a lot of very interesting content there all the time. So jumping to today's topic, responsible exits and beyond, I want to put it a little bit in the context of the prior work of the Investor Network so far. As you know, we have been working quite consistently on the topic of structured exits and lowering the reliance of investors on the contingency of a future event, whether it's an M&A or an IPO exit. This culminated last year in the report that we did with Inter-American Development Bank Multilateral Investment Fund, looking specifically at Latin America. That work has continued, and now we are pretty much passing the baton to a coalition that has come out of the work of GDI with media networks. If you mind, once again, I'll ask you to mute yourselves, please, to minimize background noise. I can't universal mute you if we want to hear our speakers too. Thank you. So there was one piece, the structured exits and alternative deal structures going in. We also looked recently, you might remember, at the steward ownership model that the folks from Purpose Capital presented to us. We'll see in a moment as the discussion continues how steward ownership fits within the context of the responsible exit. And I wanted to highlight one more piece that had been popping up in some of these conversations around the known exit as the responsible exit. So the possibility of actually continuing the ownership of the enterprise, whether in the form of the holding company that we looked at as an alternative to the closed-end fund, or otherwise in terms of many of the founders that are actually seeking to capitalize their company in a way that allows them to retain ownership and control for the long run. One quick bonus point on that is this concept that I've come across recently in a piece on TechCrunch on the quick exit as the responsible exit. So kind of the flip side of the known exit as the responsible exit. A PE fund called Think3 that seeks to give an exit and liquidity to founders much faster, much earlier than they would normally get it, with the hypothesis that they have more shots, as they say here, at giving a unicorn by doing more than one, by doing many faster iterations of their entrepreneurial as you can imagine, that has a few considerations to it that seem to go against a lot of what we have been historically looking at as the alignment of the enterprise with the investment itself and with the impact they seeking to create by sticking to it longer and not by just flipping companies, as they say in that case, in order to give more shots to these savior entrepreneurs to create their impact. Interestingly, however, on the flip side, Think3 takes these companies and holds them forever. So they hold them, as I understand, in a holding company type of structure, which again might mitigate some of the inherent issues that one would think emerge when you are flipping companies, to use their expression, sooner perhaps than they normally would happen. So how have we been looking at it over the last couple of years or so? A couple of ways in which you bake the mission into the enterprise in order to achieve this responsible exit. The first, of course, highlighted in the GIIN report is by baking the mission into the product or service itself, so that as the company grows, regardless of the ownership, you would have the continued impact. We also look at it in terms of baking the mission into the structure itself of the enterprise, in particular the governance. And there's a third twist that I think we'll discuss later on, of viewing the exit itself as the generator of the impact. On the first point, baking the mission into the product or service, I wanted to highlight this interesting quote from Sarah Cohn of Social Impact Capital that Aner Ben-Ami sent me recently, saying, one way I test for this before investing is to ask myself, what if the most evil company in the world acquired this company? Would there still be impact there, or would we be losing it? So she uses that as a front-end filter for the responsible exit by thinking of what would be a worst-case scenario for an acquisition. And I was looking today at, I think it was Terra Nutritional that Melanie Tharp mentioned to me was recently acquired by Nestle, as one of the cases where you could say, all right, is the impact that Terra was trying to have going to be preserved by an entity such as Nestle that, by and large, might have a different set of priorities from the ones that Terra had in the first place. In terms of baking the mission into the structure and the governance, again, we can think back on the discussion with Beartooth Capital and the idea of steward ownership, golden shares, different shares of classes that would keep that would have control over the mission going forward in terms of having different voting rights. That, as you know, for us is a bit of a controversial point in some very interesting ways because of the idea of having democratic control over corporations. So at the public equities level, we're interested in seeing the work that the Council of Institutional Investors have been doing around ensuring that indices are screening out stocks that get listed publicly that do not have voting rights in terms of one vote, one share, one vote. But in the context of purposely mission-driven enterprises, it actually seems to make sense to have a form of preserving the mission with a golden share that is held by a foundation or by a non-profit maximizing entity, oftentimes, or in some other form. And of course, the ultimate governance baking in of this exit would be through benefit corporation or an equivalent status, even though the folks at Beartooth Capital would probably say that even that is not enough to really bake in the impact upon an exit event. So this last twist, before I pass it on to Hannah and Hannah, where the exit itself is the impact. You could have companies that you're investing in that are not intrinsically impactful in the way that you would think of because of the product or service, but because of a broad-based distribution event or an asset-building event upon the exit, you consider that to be the impact that comes out. So it's the flip side of baking in the impact on the front end, is to say you could take fairly conventional companies, convert them to employee ownership, And through that, you have the impact if your impact thesis is predicated on creating a broader wealth distribution and asset building opportunities for the workers. This is part of a bigger project that we're doing on conversions to employee ownership. We were delighted to see that KKR Industrials has been looking, for example, at some of the exits to the workers with meaningful chunks of equity being distributed upon the exit event. So the considerations that we'll be looking through, Hannah and Hannah will be talking through this, and then the discussants, Anna and Chuck, as well as Anair and some others will pipe in on this. Ownership and control at the exit, so it goes to the issue of the mission preservation by and large, but also who benefits financially. So in the traditional transform finance principles way of looking at where the value is being created, where the value is being taken out, who is benefiting financially at the time of exit? Is there, again, broader returns to the stakeholders, or are some of the benefits now all of a sudden going to expire? Is the exit something that creates a couple of multi-millionaires, or is there a broad-based issue there? In terms of the non-exit as a consideration, you probably have seen a lot of the chatter recently around the problem with increasing concentration of enterprises in several industries as becoming this duopolies, and M&A as one of the factors, M&A activity as one of the factors that is leading to this concentration. So exits that lead to consolidation within an industry bring with themselves some additional risks in terms of the systemic distribution of power among corporations. And lastly, in terms of our usual work, in terms of lifting up voices of other stakeholders beyond the investors, who is the exit responsible to, and whose voice comes into a consideration of what counts as a responsible exit? So what happens when you have this non-aligned exit? And we'll see some of the examples from Hannah and Hannah's report. We have seen three views on this from some of our members. One is to say, well, through the life of your investment, you have already had a meaningful amount of impact. So count your blessings, and hopefully that impact will be preserved going forward. But it's already a good thing that there has been a period of impact, right? It's not an ideal situation necessarily. However, if you think of the exit as a necessary evil in some cases, right? You need to return the capital. You have oftentimes a limited number of entities to whom you could be exiting. Some folks might take the position, I think it's reasonable, even if it might not be my position, that's already good in terms of impact that you have had. The other is that even if the exit is not fully aligned, the best practices that you have brought within the company through the life of your investment will live on, right? They will become part of the general way in which things are done at the company. And in itself, while it's not baked in, while there is no accountability around that, while there is no systemic way of checking for it, you have almost this like cultural imbued impact that will continue. And the third, which actually relates to the first, is this idea that, look, impact capital is fairly scarce. If we can recycle it, and if we can put it back into circulation in new enterprises, that is probably an important consideration as well, even if this company in and of itself might be subject to a change in some of its in some of the ways in which the impact actually continues to persist. So those are just some of the thoughts that I would like us all to keep in mind. And I'm delighted to welcome now Schiff and Hannah Dithrich from the GIIN, who are joining us to describe the work that they've been doing. So Hannah and Hannah, thank you for coming.
Thanks so much, Andrea. That was a really fantastic introduction, and we're very excited to have this opportunity to partner with the Transform Finance Investor Network on this topic, which has been kind of kicking around at the GIIN for a while too. I believe, so I still cannot control the slide. So if you're able to pass the slide control, that would be great. And I'll just start by saying, for those of you who don't know us, the Global Impact Investing Network is a nonprofit based in New York City with a global membership of about 250 organizations. And we have a variety of different programs here. The research team is where both Hannah and I sit. And we produce different kinds of reports that are mainly aimed at impact investing practitioners to help them understand the market and elevate and enhance their practice by learning from one another. And so I'll just note now that all of our research is freely and publicly available on our website, which is the GIIN.org, 2 I's. And with that, let me start by telling you a little bit more about why we decided to take on this topic and produce this report. As the impact investing industry has been maturing over the years, we've seen that investors' portfolios are also maturing, and this is leading to a lot of interest in exits in general. And in particular, are they happening? And if so, what have the results been for investors, for enterprises, and also for the beneficiaries? And so in 2016, in our annual survey, we asked a question about whether impact investors believe that they have a responsibility to try to ensure impact continuity after exit. This sort of relates to those different views that Andrea just presented. We found that 80% of the respondents believed that they did have this kind of responsibility, at least for some types of investments. And so we wanted to dig a little bit deeper and understand, well, what risks are they trying to mitigate, and how are they doing that? What are the approaches that they're using? There were a few good pieces already written on this topic, but they mainly focused on particular sectors or segments of the market, like microfinance. So we took on this study. We interviewed about 30 experts, mostly investors actually, and a few enterprises and service providers. And we summarized our conclusions in this report that as I mentioned, you can find on our website. And what I'll do is just talk through kind of the overview, the main findings now, and then my colleague Hannah Dithrich will talk about the case studies that we used in the report. They're cases of specific exits. So first I mentioned we wanted to look at what is the need for responsible exit, what risks are you mitigating? And we found that it kind of depends on how the impact is being generated in the investment. So if the impact depends on a business model that provides goods and services to a particular population, for example, and that's where the kind of impact is coming from, then changes to that business model that could happen can reduce impact after you exit. And specifically things related to pricing, to the market segment being served, and to the growth pattern that is occurring could affect impact of the company if they're changed dramatically. Second, if the impact derives from policies and practices of the organization, like who you hire or how you hire, creating opportunities, job opportunities for the disadvantaged, or operating in a way so as to have the least amount of harm on the environment possible, then you'll want those practices to continue, and if there's a change in ownership, there's a risk that there might be reduced emphasis on those. If the asset is land or real estate, the way that it's managed could affect the impact after you exit. So, for example, land that's meant to be conserved could be developed and built on, or in the case of, let's say, an affordable housing development, a new owner could fail to provide a safe and supportive environment for the tenants of that housing development. And then lastly, really any kind of failure to provide the business with the resources that it needs to continue to grow and evolve can result in less positive impact. So, this does kind of set impact investors apart from other investors. You're looking for new investors that can continue to support the company with the resources and the expertise and the finances also that it needs. And so our sort of overall takeaway about how investors approach responsible exits is, first of all, that there's a variety of approaches. So I do think there's not just one uniform approach, but in general, it's not something that just starts with the exit. So impact investors do plan for responsible exits throughout the whole life cycle of the investment. And what I'll do now is I'll kind of just walk through some of the considerations and things that we heard from investors at these different stages. So before you even invest, there are several things that you can think about. Andrea already touched on this quite well. Is impact embedded in the business model? So is it really intertwined with that product or service, and therefore very unlikely that it'll change no matter what, no matter who buys it or who's investing in it. So that's one way. Secondly, does the growth trajectory support a responsible exit, and sort of who are the likely acquirers? So I think this relates to the Sarah Cohn quote that Andrea brought up. So what will that exit path look like, and is it likely to be a responsible exit? And then who are the founders and the management team? And we heard a few different investors talk about kind of looking for those for whom mission or impact is just part of their DNA. So are they deeply committed to it and really baking it into the enterprise? So then once you've selected your investment and you're ready to structure it and agree on terms, investors that we spoke to found that thinking about the type of capital that the business requires is really important for laying the foundation for a responsible exit. If the company requires patient capital and you're working with a structure that forces you to exit in a particular time frame and it might be too soon, then that's a risk. Likewise, if there are expectations for kind of hockey stick, really rapid growth in too short of a time period, then this can create different types of pressure on the company. For example, for unsustainable growth, to raise margins, or, for example, in the case of microfinance, it can lead you towards practices that will result in over-indebtedness for clients. But flexible payment terms can help address the needs of certain types of enterprises, especially early stage ones that have more unpredictable and less even cash flows. And, for example, loans that have equity-like features can combine some of the attractive elements of both debt and equity, since they avoid equity dilution for the founders and also enable investors to participate in some of the upside of good performance by tying the payments to the revenue. Another important element to consider at the time of investment is the co-investors and who they are. Are they aligned in terms of their vision for the company? And this isn't to say that they have to have the same impact objective or impact intent as the impact investors, but they should have a similar view about where the company is headed and how it'll get there. And so lastly on this, is there a way to incorporate impact into legal structures? And Andrea mentioned benefit corporations or B Corps. There's also some ways of integrating it into shareholder agreements. And I think that this is something that one of our speakers, Anna Kanze, will be able to speak to as well, since I know she's done some thinking on it. Okay, so now you've made a loan or bought some shares of a company or another asset. Now some investors look to improve the policies and practices of the company and instill these within company culture. So for example, one investor that we spoke to sets objectives with the public companies that they invest in and then supports them to achieve these goals. So for example, with a meatpacking company, they helped them to establish and publish policies on animal welfare and the use of antibiotics. And those, once they're public and committed to, will definitely outlast the tenure of that investor's participation in shares of that investment. So at exit is obviously a critical time with lots of different considerations that come into play. And for starters, many investors consider the exit timing itself as a main factor in managing for impact. And they want to exit at a time when they've sort of reached a limit in terms of the value that they can provide as investors, and also when the company is really ready for new capital and for the next phase of growth. Also, selecting a buyer is a crucial element, and impact investors have various criteria that they'll sort of mix and match for different deals or depending on their strategies. But often these include things related to that new buyer's track record. How have they managed past investments that they've had? Are there any concerns related to their practices? And also their motivation for making the acquisition, as well as their alignment in terms of the vision for the company. And then last here, the possibility of ensuring management continuity is another method that's used, and this is especially important in the case of acquisitions, where there's often a change in leadership and who will be managing the operations of that company. So in addition to this kind of overall question about how do impact investors approach responsible exits, the question that we wanted to consider was related to trade-offs. This comes up a lot. Is there a trade-off at exit between the financial return objectives and the impact objectives. And what we found was about half of the investors we spoke to said that they never face such a trade-off, and the other half said that they sometimes do, and they shared with us some thoughts on how they address the possibility of a trade-off. And so what I've put up here are just illustrative statements based on the experiences of investors that they shared. These aren't quotes, they're just sort of summaries of sentiment that I've heard. So those who say that it's never an issue, that they never face a trade-off, kind of had two main reasons. Either the first one was, they invest only in businesses where the impact is naturally embedded in the business model, and so that means that their potential buyers will see the value, the commercial value in the business model, and pay a good price for that. So they'll look to maintain and grow the company along those lines because it just sort of makes sense, and so therefore it's not an issue. On the other hand, some investors just prioritize impact, so they don't really see it as a trade-off because that's where their priorities lie. Among those who sometimes face trade-offs, some noted that there's a risk that when a buyer pays a very high price, they might not be as able to invest further into the company as needed, and also that they could face pressure to cut costs, to raise prices, or otherwise shift the business model, for example, to more lucrative segments, which could reduce the impact. Some handle this potential for trade-off through a kind of two-stage screening process. So what they'll first do is screen out any buyers that don't seem that likely to prolong the mission focus or that they have concerns about from an impact perspective, and then they select the highest bid from among that remaining set. So they don't, that kind of reduces the sense that it's a trade-off because they're still selecting the highest bid. They're just selecting the highest kind of feasible bid that meets their other requirements. So I'm going to stop there, and I'm going to turn it over to my colleague Hannah Dithrich, and she'll walk you through some of these specific case examples that we used in the report to illustrate these findings. Here you go. Great.
Thanks. So the report includes 4 case studies that represent a range of investment strategies and illuminate some of these different approaches to responsible exits. So I'll briefly go through them and kind of touch on 1 or 2 interesting aspects of each. So the first is Leapfrog. Leapfrog is a private equity firm investing mainly in financial services and healthcare, targeting underserved populations in Africa and Asia. Leapfrog invested in a life insurance provider in Ghana called Express Life, where at the time they were launched, only 2% of the people in Ghana had life insurance coverage. Leapfrog invested to help grow the company so that it could serve more customers and also to help improve its governance, risk management policies, and encourage it to provide more kind of simple products to its customers. So Leapfrog's general approach is to invest in companies that have this kind of profit for purpose model that we've been talking about, that provide goods or services to low-income populations, and therefore have impact really baked into the business model. So because impact is kind of inherent to the business model, Leapfrog then seeks buyers that really understand the commercial case for serving this low-income or emerging consumer segment, as well as how the model inherently creates impact through that. So rather than really binding an acquirer to a social mission and making it kind of more of an obligation than an incentive, they look for buyers that really see the commercial strategy and have the resources to really help the company just scale up its operations. So Prudential PLC wanted to establish a presence in Africa, and they recognized the value proposition of serving this kind of high-growth, low-income customer segment, and they believed in the business model and its inherent impact, and the resources and insurance industry expertise to help Express Life scale. So they also worked with Leapfrog to understand the unique risk profile of the Ghanaian insurance market. So I think, again, this is a good example of investing in businesses with impact really baked into the business model, into its products or services. And in these cases, what we heard from investors is that as long as the acquirer or the buyer really believes in the value proposition, and then also has the resources to help grow the company, impact should continue as well, as long as the company can scale effectively. So the second example that I'll touch on briefly is Beartooth Group, which acquires land in the western U.S. for restoration and conservation benefits. So Beartooth acquired a 1,000-acre piece of beautiful land in this photo in Montana with the intent to restore the land and then conserve it as well. So once most of their restoration objectives had been met a couple years into their investment, they invested in 2010, and in 2012, most of those had kind of been completed, and they began searching for a buyer. And they actually didn't sell until about 4 years later in 2016. So the brief thing I'll touch on here is that, of course, this is an example of the benefits of really having some flexible timing to look for an aligned buyer. And they ultimately waited and selected a buyer that was a family with plans to really preserve the land and conserve it for future generations. And in fact, Beartooth often plans for scenarios like this, where they might need to hold property for longer than expected in order to wait for a buyer that they feel is aligned on mission. The third example profiled in the report is Adobe Capital, which is a PE fund manager focused on inclusive growth for low-income or basis of pyramid populations in India. They focus mainly on financial inclusion, and they seek investees with kind of a customer-centric approach and really focus on client protection. They've achieved many successful responsible exits, but they actually shared an example where, in retrospect, things could have gone potentially a little better. So, of course, in addition to sharing success stories, I think it's important to understand also from experiences like this. So they invested in a microloan company, and they began seeding buyers, potential buyers, a few years into the investment. And then a couple years after that, the end of the fund was approaching, and they hadn't really found who they'd characterize as the ideal aligned buyer. They usually seek buyers with both an attractive financial offer, but also that really believe in the business model and also have some expertise with the sector or with the customer segment that they're serving. So because the end of the fund was approaching, they ended up selling to a gold loan company that had some general financial expertise, but little kind of real microfinance experience or knowledge of that customer segment. And then looking at the microloan company after they exited, they did see some kind of potential risks that we touched on earlier as well, like growing loan sizes and just kind of generally raising concerns about over-indebtedness or client protection in general. So looking back at what they learned from this experience, Loke said they could have potentially pursued a couple alternatives. Not all of them were necessarily viable or of interest to their LPs, but one would have been extending the life of the first fund in order to wait for a more aligned buyer. Another option would have been to roll over the shares from the first fund into the second fund if those LPs would have had interest in that. And then a third option, which we also mentioned earlier, would have been moving the shares into a holding company that then could have owned the company and allowed it to continue operating while the fund could liquidate. So then the last example is Adobe Capital, which some of you I think may be familiar with them. Rodrigo spoke on a webinar, another TFIN webinar recently. So in this example, Adobe invested in NatGas, which is a natural gas company that converts public buses and taxis in Mexico from traditional to natural gas, and then also operates a network of natural gas fueling stations across the country. So this case study is a great example of alternative financing structures in place of the kind of more traditional PE structure, and approaches, especially those that can be tailored to the needs of early stage enterprises and really focus on supporting sustainable business growth and also not jeopardizing this sustainability exit. So Adobe used mezzanine financing, a combination of preferred equity and convertible debt with a revenue-based repayment system, which can be much better suited to startup or emerging enterprises with unpredictable cash flows. And then also for nat gas, the mezzanine financing also helped mitigate some equity dilution. And then for Adobe, the self-liquidating nature of these convertible loans allowed them to start receiving repayments early on to help mitigate potential losses and also reduce some overall risk to their portfolio. And then also in the case of financial underperformance, Adobe had the right to convert some of the unpaid loans into equity to also enable them to participate in any future upside potential. And then there was also an option to sell some of its shares back to the original shareholders in NatGas's first equity raise. So they did exit 2 years into the investment when a PE fund focused on alternative energy investing wanted to invest. So Adobe sold their remaining shares to the existing shareholders in order to consolidate the shareholder structure for NatGas. So I think this, again, illustrates kind of the potential benefits for both investors and investees or enterprises of these types of kind of creative financing models in place of potentially the traditional PE approach, especially those with these kind of reflectable repayment options that can help facilitate a responsible exit by really limiting the pressure to necessarily exit on a specific time frame. So I will stop there with these case studies, and I think I hand it back to Andrea. Again, yeah, I'll mention the report as well as our other research. It's available on our website here, and these are our emails as well, so please reach out to us with any questions on this report or on any other topics. And yeah, I'll hand it back to Andrea.
Terrific. Thank you so much, Hannah and Hannah. We will switch in a second over to Chuck Holt from InvestEco and Anna Kanze from Grassroots Capital Management. But I see a couple of comments already came in through the chat or otherwise. So if you don't mind, let me turn it over to, let me see who was first here, to Aner Benami from Adobe Group, also one of our founding members here. Hi, Aner.
Yeah, hi, and thanks, Hannah. Yeah, no, I really appreciate these case studies. I think are really highlight a couple of the, the issues that we see, and the framing around some of the risks, the framing up front around the risks to the model. I think the main comment I would have is the risks you frame up front and all the ways that business practices could stray, could stray away from mission over time. And I think actually some of these case studies highlight these, the various degrees of aligned exits, great, not so great, pretty bad. I think those things all kind of dispute the point that you've heard from some of the investors around the notion that as long as the impact is sort of baked into the business model, then we sort of don't have to worry about it, right? I mean, the quote that Andrea shared up front from Social Capital, right? Is that the name of the fund? Around, if the impact is baked into the business model, then you sort of don't have to worry, and it could get acquired by anyone, and it would still be impactful. I think we would really dispute that, right? Strongly. I think ownership matters. I think we'd be hard pressed to find any example of where it doesn't matter, right? I mean, I think there's certainly some business model where the risk is higher or lower, but to take the example of the say that Leapfrog investment, where it's a company that is serving low-income communities with life insurance, and so the business model is impact-driven to begin with. It'd still be sort of ridiculous to think that it doesn't matter if that ends up being owned by, KKR, or being owned by a foundation, or being owned by, the workers, or those are vastly different outcomes for the business in the long run, right? And otherwise it's sort of a very static view of the business, right? Businesses go through ebbs and flows and challenges, and have to make a ton of decisions around hiring practices and how they treat their communities and how they treat their customers. And so I would say, I think just in terms of general framing, we'd say, ownership always matters, and we can't just kind of let ourselves off the hook by saying, oh, the product itself is inherently impactful. We're selling solar lamps in Africa, we're selling water purification solutions in Haiti, therefore we don't have to worry about it. I think it kind of always, there are always issues, plenty of issues that matter. And so I'd say some of these case studies actually highlight what I think some of the key levers are, because we're not always going to have the option for a structured exit like a revenue share or something along those lines of what Adobe did. Oftentimes it is an equity investment. You do have to think about a transfer of ownership. And I think what really matters in terms of a broad framing is the degrees of freedom and the flexibility that the investors and the founders leave themselves in sort of the equation. And so just things as simple as, how much capital are you raising, right? The more capital you raise, the more you sort of limit your degrees of freedom in terms of what you can or can't do by way of liquidity. Who the investors are. Are they 10-year funds? Can they wait it out like Beartooth Capital did, or are they really time pressured to exit? Is the company driving quickly to profitability so that they can bide their time? And I think one of the quotes on your slide around, is there a trade-off or not? There was a quote there from an investor that they will pick the more impactful buyer. Well, you can do that if you have freedom, right? If you have time, if you're profitable. And so framing it, I think, within the context of, trying to maximize your flexibility and freedom by raising less capital, being profitable earlier, having investors that have a bit more flexibility in terms of their hold period. Those seem like really critical to us.
Great. Yeah, thanks for that, Aner. I don't know, Andrea, if you want us to respond or if you want to move on to the discussion.
Since there were some questions and comments that came in through this, if you don't mind, why don't we start responding to some of them, and then we'll move over to Chuck and Anna, and then we'll come back to a broader group of questions.
Sure. So you wanted to take another question, or you want us to respond to the questions and comments that Aner just raised?
Well, it seems like there was a lot to what Aner said, so if you want to tackle that, then
Sure.
I'm keeping a deck here of the points that are coming in. Thanks.
Okay, great. Yeah, thanks, Aner. And I really like the way that you kind of tied it up together at the end around one thing that you can do is just try to maximize your flexibility and freedom, and then what are some of the levers that you can use in case you're not able to do that. I think that's definitely in line with what we were presenting. I think it's just mainly what we found was that there's really no one-size-fits-all approach to this. So much depends on the objectives and strategy of the investors and the type of constraints that they're working with also. And so, that point about impact embedded in the business model, maybe works for some and not others. I think I would also note that in terms of what you're saying about the Leapfrog case, they definitely, when we spoke with them, highlighted that the selection of Prudential PLC was important to them, finding someone that they were comfortable with in terms of bringing the expertise to operate a sort of very responsible and rigorous insurance business, and that value in the sort of impact piece of the business model was important to them. So I don't think that, I don't think it disagrees at all with your point that it does matter who owns it. Yeah, I think that's kind of what I would say, and also just thanks for those reflections on it. I think that was really interesting summary to hear.
And I know when even though it was acquired, when they were looking for an acquirer, they kind of sought to really have a clear understanding of what Prudential PLC's plans were for managing the company going forward, and look for kind of major potential risks like big mergers that might result in employee layoffs or stuff like that kind of could pose a risk to the operational impact of the company. And then in some other examples of acquisitions where there's new management and the founders don't stay on, there's the famous example of Ben & Jerry's, for example, which doesn't quite fit into the same kind of impact really embedded into the business model in the products or services. But even though there was a new management team, they established kind of a specific,
like a
board.
They had a separate board that was responsible for the social aspect of their business model.
Yeah, exactly. So kind of establishing a specific board and management to continue on just focused on the kind of socially responsible operational practices as the model to make sure that those kind of continue.
Terrific. Thank you. And there's one more comment from Donna Katzin before we move on to the second presentation. Thanks for fielding these questions while they're coming in. Donna, I believe you're dialed in from the phone, so I will unmute the phones and hopefully we'll hit yours.
Great. It sounded like it did.
Yes. Everybody else,
thanks.
Please stay muted. Thank you.
Okay, thank you so much. My question has to do with a challenge that a number of small and growing businesses face as they exit as investees. And one of those, I think you alluded to it in the very beginning, is access to ongoing capital. So it could be a liquidity crunch, it could be the level of capitalization, but sometimes when the investors pull out, there's a need for continuing access to capital. So I wondered whether you would run into any cases of businesses that or exits that contemplate this. We've just worked with a cement company in Mozambique, for example, that was in the process of exiting, and it was very helpful for them to have the guarantee so that they could meet their ongoing operating needs while they got their production up to the level to being able to not need the loan.
Thanks, Donna. Yeah, we did actually. It was interesting. One interviewee spoke to actually providing an exit as the most responsible thing that they could do. There was a company that they weren't working with yet that they identified needed a refinancing so that they could provide an exit to another investor that would have been kind of stuck without that. So the responsible thing for them to do was actually be the off-taker for this company. So we did see that. And then, I think that what you're talking about speaks really well to the timing question. So if you do know that you have to exit at a given time, what are the things that you should do to make sure that the company is ready by that time? And obviously that's the ideal scenario, and we all know that things sometimes go sideways and you just can't predict and plan for everything. But to try at least to kind of mitigate the risk that you're going to leave the investee in the lurch, definitely something that we heard about. So that might be related to kind of the ongoing monitoring and management of the investment and what kinds of support you provide them. I think it also relates to what Anna was saying, like try and become profitable as soon as possible so that you're less open to that kind of risk. I don't know if there are other. I think it's probably it is a tough challenge for SGBs and one that many face.
Great, thank you.
Thanks, Donna. Yeah, I would only add to that looking at the provision of liquidity or a liquidity facility in the on the front end as part of the impact that an investor can have is probably a meaningful part of this equation. And I'm thinking of some of the efforts that MacArthur had done in setting up ex ante some liquidity facilities so that you would have the properly aligned capital when the time comes for the investors that find themselves in the position of having to exit. And you can think of that also as an impact bridge, perhaps. I don't know if that's a term or if it's not a term yet, where you line up the capital ex ante so that if you find yourself in the position where you don't have the aligned buyer, you would you would have it there for after. In a very different context, in the context of real estate here in the United States, we were looking at some circumstances where properties are coming onto a hot market, as is the case now in Atlanta, and there are there is not yet, say, a community land trust or another well-organized system in place to take those properties. So having capital already lined up from the beginning to bridge over to when there will be that more impactful acquisition. You know, it's an exit in the sense of having like the exit upfront from whoever is owning it, not going to the purchaser that you don't want, but ensuring that over time with that bridge can go to the other purchaser. That perhaps gets us out into the weeds a little bit. So meanwhile, I will turn it over to Chuck Holt from InvestEco that has been very patient with us so far. Thank you for joining us, Chuck.
Thanks, Andrea. And thanks, Hannah and Hannah. I really enjoyed the GIIN report. One thing that struck me was just how it fits with the InvestEco experience in terms of things we do pre-post investment and post at exit. It's good to know there's so many aligned investors out there. But to Andrew's point, I think one of the important things to preserve mission is allowing flexibility or preserving flexibility at exit so that the management can decide what to do to best move the company forward. So that's why we like structured exits, which is what I'm going to talk about. Just quickly about InvestEco, we're a private equity firm in Toronto. We invest in small, fast-growing, sustainable food companies, and by that, that's companies that provide an environmental benefit and maybe a social benefit as well. We consider ourselves a impact investor. We are B Corp, and many of our companies are as well. One thing we've discovered over our years, we've been around since the early 2000s, is that in this space, in the sustainable agriculture space, in the size of companies that we invest in, they're typically $1 to $20 million of revenue when we start out. There's not always an obvious exit. You double, triple the size of the company in your hold period, but it's not necessarily going to be an obvious acquirer at 10, 15, $20 million of revenue. So through trial and error, actually, over the years, we've developed redemption provisions that allow the company to buy back the equity from us after about year 6 or 7. That helps them preserve their control. It also reduces the risk to us, right? So that's the main benefit to us is we're able to make an investment because we know we will have some option of getting out after a number of years. But there's also benefits to the company. First of all, they retain control and they can retain their mission. But it also avoids to scale up too quickly. If we know we can get out when the company's at $15 million revenue or whatever, we don't very quickly. Because there's meant that we lower our cost of capital and our required return in order to make an investment. And of course, with these redemption provisions, if it's a bullet redemption in 6 or 7 years, the management always has the freedom to finance their redemption. Hopefully, they've developed some EBITDA and they have cash flow available to finance the redemption, or if not, they can find debt or a new equity investor, especially if the redemption provision is over a couple of years, which allows them to find new investors. But it's really important to know that these different provisions, they don't create value out of nowhere. There's always trade-offs being made. So if you use the cash flow in any sort of self-liquidating investment scenario, if you use the cash flows of the company to finance your redemption, you're not using that to grow the company. Like it's a fast-growing company. You invest in the company. Hopefully, you have 20-30% growth. So you're not. It's a trade-off there. You're paying off an investor, not investing in the company and the company's growth. And anytime there's more risk to the investor, the cost of capital is going to go up. So if you have a redemption provision, it's not as enforceable as, say, debt, right? You can't, because of insolvency laws, you can't require redemption. You can't put a company into bankruptcy because they couldn't fund the redemption, whereas you could if it was debt. So there's more risk to the investor in terms of being able to enforce their return. And that's the same, there's more risk to the investor if they had a royalty payment too. They don't know how much money they're going to get. They're going to have to ask for more money up front or more money in that royalty stream to make up for that extra risk. So there's all these trade-offs. There's no money being made out of thin air, but what's great about an equity redemption provision where we sell the equity back to the company is that it reduces that risk of not being able to exit at all. So it makes an investment possible where it might not have been possible previously. And that's the real value, I think, in an equity redemption as a structure to exit. So I'm going to talk about one case study, and this is organic food cooperative we invested into a while back, and it was early on in the days of organics. The co-op, it was a co-op, and they had a lot of growth opportunity, but as a co-op, they didn't have a lot of assets to raise debt. The farmers had assets, the co-op didn't, and they needed the cash flows that they had to invest back into the company. They couldn't pay interest. And at the co-op, they weren't really able to raise equity because of the one member, one vote structure of a co-op. It's difficult to provide the investor protections that an equity investor requires. And it's difficult to know how you're going to monetize that investment eventually because a co-op is structured as membership and not as shares that can be traded. So, and this co-op wanted to maintain their twin missions, be organic and to be farmer owned. So our solution was to create a for-profit subsidiary. And this allowed for a more traditional investment structure, one where we could, as an equity investor, we could have minority investor protections. We could issue shares and warrants and options, and the banks would understand where we're coming from. And when it came time to raise debt, you take security over the assets more easily. And this was to be owned by the co-op. And so what we did, we invested in a convertible note that allowed us several months to see the new business model in action before committing to equity at a predetermined price. We didn't take interest, it just accrued, so it turned into equity. And ultimately, when we converted, it was a 20% stake in the subsidiary. And that, so then that meant that the farmers still had majority control even during the state of the investment. But the key part of the investment structure was the redemption right. So after 3 years, we were able to sell back our 20% stake at fair market value to the co-op. So the co-op would own 100%, which they wanted to do. And it was at fair market value, which had to be determined, of course, but it was at fair market value, so we knew we were getting full value for our investment. And we allowed them about 2 years to find new financing to finance it. They ended up taking out debt. They had become cash flow positive and they had lots of assets, so they were able to do that at that point. And ultimately, we got out. It was a great investment, and at the time of exit, everyone was very happy. There you go.
Great. Thank you, Chuck, for that. And some of you who saw our earlier report on the innovative financial structures for impact enterprises will have seen the example that we brought up from Acumen in Colombia that did a very similar structure, but where the company in which the redeemable equity went was not set up as a subsidiary, but was well. Actually, I think that we can stick to the example that Chuck brought up for now for the context of these exits. So let me turn it over to Anna. Thank you very much, Chuck, and then there will be a chance to ask you questions. And for the participants, please feel free to send them through the chat as you've been doing so far. Thanks for joining us, Anna. You have the presenter privileges.
Great. Thanks, everyone. Thank you, Andrea, for putting this together, and happy Valentine's Day to all. I'm the distinguished last presenter, so I'll try not to take up too much time before the Q&A. My name is Anna Kanze, and I'm the COO of Grassroots Capital Management. Grassroots exists to strengthen communities and help alleviate poverty, and we advise and co-manage impact funds that mobilize investors' capital to support institutions that aim to do that to strengthen communities and alleviate poverty. A large portion of our investments has been in the microfinance sector, given its demonstrated potential to scale. So I'll mostly speak from that experience. Establishing a commercial track record is very important, and at the same time, we have been early and vocal advocates for a more comprehensive appreciation of value to encompass a more inclusive set of stakeholders. So it's also very important for us to see this value continue after exit. So responsible exits are something that we have been discussing and working towards throughout our investment career. But to echo the research and also the previous speakers, for this to occur successfully, the groundwork must be established as early as investment selection and reinforced throughout the investment lifecycle. So through investment documentation, guidance to management, and board participation and oversight wherever possible. Over the past 15 years, Grassroots and our partners have helped to launch and manage 8 debt and equity funds, which have had over 20 full and partial exits. We are patient investors. However, most of our funds have been closed-end funds, so we do have a limited investment period, and we do need to divest at a certain point, usually within 5 years of having made the investment. Which doesn't really give us very much time in this space, given the limited liquidity of the markets where we invest. And additionally, as mentioned in the chat box by, I think, Delilah, our LPs in the funds have certain financial expectations, which we need to be cognizant of. So this is why investment selection, clearly articulating objectives and alignment of expectations at the time the LPs invest in our funds, and also at the time the funds invest in portfolio companies, are very important. So LP expectations have an effect on the types of exits we can pursue and hope to achieve. And we as fund managers need to be aware of that and be clear on how the expectations and the returns and the impact are all connected and affect each other. Our exits have been to management, strategic buyers, and in a few, actually 2 cases in 2016 in India through an IPO. So the 2 IPOs really exemplify the first point on this slide of hardwiring the mission. These are 2 financial institutions which wanted to transform into small finance banks, which is a special designation in India that enables deposit taking and also requires that the bank continues to serve underserved clients, so continues its commitment to its mission. To become a small finance bank, the foreign shareholding had to be below 50%. So the only way for these institutions to achieve that really was to become public. And their social activities, as in serving the economically poor, were clearly communicated throughout the IPO process. So on roadshows, through this prospectus, and so on. And the balance and symbiotic relationship between their social and financial activities was what arguably drew investors who appreciated these things and shared those values, and was one of the reasons why these investors were attracted to this institution and chose to purchase shares. Additionally, this was communicated through the pricing. In the past, IPOs in the financial inclusion industry were at high valuations, and this led to public backlash as they were seen to encourage irresponsible growth or high prices in order to justify the high multiples, as Hannah mentioned. So this pricing was, in these two cases, the pricing was aligned with the social mission of the organization. And lastly, the founders had limited shareholdings, as the shareholder base of both institutions was very diversified and included employees. So employees were able to benefit from the IPOs as well. Of course, not all our exits, or even most of our exits, are IPOs, and not all our portfolio companies are this clear about articulating the relationship and balance between their social and financial goals. A number of institutions in our portfolio, especially those that are more socially oriented, choose to stay nonprofit organizations, or the founding nonprofit buys back the shares because they're worried about mission drift. And this limits their growth opportunities and their development, as well as their achievement of their social objectives and our fund social objectives, since a main objective of our funds is to professionalize the institutions in which we invest and facilitate access to more diverse funding sources. We're often the first and sometimes the only institutional investors in our portfolio companies, and so we try to work with our companies on articulation of their mission and enshrining this in documentation so it can survive changes in ownership and other events through the life cycle of the company. But as has been mentioned, ownership does have a very big impact on the company. So as much as you bake it into the culture and the products and the services, it still does matter who purchases the company. But we hope that, through helping our companies sort of signal their commitment to their mission, and then also measure, monitor, and communicate their non-financial performance through initiatives like GIIRS, the Global Impact Investing Rating System, this better reporting and data will help potential investors self-select those companies because of their social value and not just as an add-on or in spite of it. And with that, I'll hand it back over to Andrea.
Great. Thank you so much, Anna. So, yeah, two great examples that I think contrast a little bit with the examples brought up in the GIIN report itself. There's one additional element that I wanted to tease out a little bit, either with Hannah and Hannah from based on the GIIN report and what they've seen, or with Anna and Chuck from the fund perspective. And it seems like the idea of the responsible exit as portrayed here is a little bit predicated on the good intentions of the fund manager, right? We're assuming that maybe at the next stage there might be less interest in the impact than what the fund manager herself or himself has. And I want to tie that with one of our prior discussions on tying the fund manager compensation to the achievement of the impact itself throughout the life of the investment, but also upon the exit. Some of you might remember, if you were on the webinar that we did with the Media Development Investment Fund, the carried interest for the fund is divided half and half between financial returns and impact returns. And a 20% of the impact return is based on having a responsible exit, as they might call it, or as an aligned exit. So I'd like to see if any of you have experimented with that. Hannah and Hannah, in your interviews, have you come across any fund managers that are doing that, or how are you all thinking about it? Anybody, feel free to go ahead.
Yeah. So I think, so if I summarize the question correctly and understand it correctly, it's about whether we've seen examples of fund managers choosing to tie incentives and compensation to impact achieved.
More specifically in the context of the responsible exit. So if we are saying, how can we ensure that our exits are responsible? Have you seen funds besides the Media Development Investment Fund that ties their carried interest or some other form of fund compensation to the aligned exit itself?
This wasn't something, I mean, there are a few other examples in the reports from Transform Finance Investor Network that I've seen, but we didn't ask specifically about this through this research. I will say, and this relates to Delilah's question in the chat also, that we talked to LPs as well as GPs, and so we wanted to also get the perspective of, how do you, if you're not the one sort of directly managing the investment and setting up the exit, but rather you're an LP investing in a fund, what are some of the considerations at that level, and how do you put in place the measures for a responsible exit? And we found that those LPs sometimes do include impact terms for GPs in their shareholder agreements, and more often they just sort of screen their fund managers to make sure that they're comfortable with the process that the fund manager is going to use to find an exit that they think is responsible. And so I would say, more commonly we heard that it's about a part of how you evaluate the fund manager, their processes, and what they do. Again, we didn't ask specifically about the financial incentives. We did ask this question in a recent survey that we did on impact measurement and management practices, and I don't have the stat at the top of my head. I don't know if you do, Hannah, but there was some percentage, some minority of funds that are doing that. Mm-hmm.
Well, there's some funds that are incorporating impact terms. There's quite a few funds incorporating, or investors incorporating impact terms into various legal agreements, including shareholder agreements and LP agreements. But we didn't gather data specifically on whether carried interest is tied to impact achieved and how that comes out at exit. And we do see that some investors are collecting impact data. Most investors obviously are collecting impact data throughout all stages of the investment process, primarily in the pre-due diligence and while they're invested stages, and less so at impact, but some are also doing it, at exit. So some are also doing it at exit, but we didn't delve yet specifically into whether the carried interest is specifically tied to impact in that instance.
Great. Yeah, and I will add that the Media Development Investment Fund case that I mentioned, that I think is the only one we've come across that looks at that impact, carried interest tied to the impact upon the exit as opposed to upon the selection. In their case, they had a specific provision that hints at the possibility that even if the exit might not be fully aligned, it's still a good exit, right? It might be a good exit for a variety of reasons, maybe because you need to, recirculate the capital, as we were saying earlier, or because of the fund economics, to say we'd rather, keep this, and we've achieved 80% according to their 80-20 division there of the impact, even if the exit is not fully aligned, which again seems like a fairly interesting, pragmatic response, if nothing else, to this issue. Let me see here through the chat. So Leonardo is asking who defines and how is the responsible exit defined in the Media Development Investment Fund example. I can share with you, Leonardo, the scale that we had presented on a previous webinar from Media Development Investment Fund. I was wondering, let's see, Delilah, did you want to ask your question? I will unmute you for a second.
Hi, sorry. No, I just want to thank everybody for addressing, I think, to the best information we have right now, my question. I'd love to see a part 2 on this about terms at the fund manager level and sort of negotiations with LPs and how to find aligned LPs and sort of what that means for broader systemic market dynamics, and how we can think about this at a more systemic level in mainstream finance. So that's all. Thanks so much.
Great. Thank you, Delilah. And I see Anair had a question.
Question for Chuck. I think we see a lot of potential with these equity redemptions and think they're generally kind of underutilized. When we've looked and have tried to apply revenue-based revenue loans or demand dividends in several cases, and have just kind of found that depending on the amount of capital that's required and what the business looks like, it's often just hard to make those numbers work and make those numbers pencil. You mentioned this, Chuck, in terms of taking capital out of the business over time, and so I think this sort of expands the universe of investable opportunities. It makes some businesses that don't fit into the venture model more investable, as well as some businesses that don't fit into kind of the revenue-based financing model more investable. So I'm wondering, I think, kind of what are some of your criteria? What are examples of businesses that this makes investable that you wouldn't have been able to otherwise using just kind of the venture model, or vice versa? Or what are some of the cases where you would have wanted maybe to use this sort of strategy, but you're worried, the numbers wouldn't work, they need too much capital, or what are some of the limits to this strategy?
Well, I think in terms of companies where it will work, it's companies that are profitable and will have options for financing this company. And it's companies that in a different sector or in a different geography might have an easy acquire. I mean, if a company can grow from $5 to $15, $20 million, it's been a great investment, and if they've got the financing capacity to take you out at fair market value, that's perfect. The issue is it has to be, or it's good to have the equity redemption feature where you're not in a geography or a sector that $20 million is going to be enough to attract a bunch of bidders to buy that company. So, I mean, we're working on right now with a food distributor, sort of an example, like a perfect example, where at the size of food distributor, at that sort of like, there's not many big food distributors who are in the M&A mode. So if you're at $10, $50 million of revenue and profitable, even, you're just still not going to get out. So it's really that sort of really healthy company that's growing. It's just not at a point where there's an exit, a big company, or there's an obvious financial exit or strategic exit at that stage of that size in that space. So that's the type of company where it really works for. What was the other part of the question?
Well, where it wouldn't work, I guess, or where or maybe there's an example where you've tried to do it.
Well, we have this feature in most of our agreements now. It's, I guess, less likely to work in situations where there are already investors in that are expecting, or co-investors that are expecting a big return. If it's a bit super high growth and more hot sector, and you don't have investors who are aligned with the sort of slower growth or the model, it's really probably pressure from co-investors, or if it's in a space where the co-investors are less amenable to it, that's where it wouldn't. Or when there's no cash flow and no other financing, if it's going to be a loss-making company until it's a very large size, that's not going to work either. You're going to have some profitability or some way to raise the financing to finance the redemption.
Great. Anything that Anna or Hannah wanted to add to that question from an air?
No.
Great. So let me turn to a question from Laura that builds on some of the prior conversations that we had. Let me see here. So she's looking at cases of the corporate buyout type of exits where some of the local enterprises, perhaps similar to the case that I mentioned at the beginning of Terra Fertil going to Nestlé, end up extracting the value that is being created when there is a large corporation that takes a company, might displace it, loses the local ownership, and the like. And so she's looking at it in terms of the actual sort of corporate exit, so a strategic acquisition as an increasing trend in all private capital, both impact and non-impact, and was wondering what you have seen, Hannah, in the report, or as you were doing the research for the report on considerations of the extraction, and essentially, bringing up to the global north the companies that have been de-risked essentially in the global south, right? The result is incubation work going, and then a corporate in the north says, "Great, I'll take this one, that one," and you're stuck with the dogs.
Yeah, I'm trying to think of any examples, and none come to mind. I mean, that's the few examples of strategic acquisitions that we saw. And I guess I'm maybe just a question back to you. I'm trying to understand what you mean by the extraction. So taking the value, can you just say a little bit more about that? Like taking the value that was created somewhere and bringing it somewhere else?
In the general sense of saying where does the value continue to accrue from a company? Right, you might have a local company like Terra Fertil that gets bought out by a corporate. What are the possible consequences of that? One is that the flow of wealth creation that would continue within the community if the company stayed there now accrues to a corporation possibly elsewhere. It might be that they buy the company for the brand, but the jobs and other local opportunities get taken out. And the spin that I was putting on it is more from my usual obsession with the de-risking that has been done in early stage impact investment, where if you have the Mexican ecosystem in this case that is seeding 100 different companies, right, and is bearing the risk of doing so. Yeah. When an outside strategic acquirer acquires one of them, which is a very reasonable thing to do, you have to look at it ecosystemically by saying, okay, you're stuck with the 99 that didn't quite make it, but you've provided all this ecosystemic service in terms of incubating those 100 for the one that gets taken out. The wealth that is being created through that acquisition probably will not be broadly distributed, right? It will go into some Swiss bank account. Now I'm just riffing on some of Laura's prior conversations.
And I wonder, I mean, I think that's an excellent point and probably is a consideration for some people who think of their impact as including the impact for the owners, the employees, the communities, et cetera. But I would wonder if, the best thing for that company in terms of helping them grow and therefore expand the impact that company can create, if this exit option was the best one from that perspective, if that's just the tough choice that you make, or if there is, in fact, an alternative in a local company that could have acquired it, then that would be, potentially a better option. But maybe it's the sort of thinness of large companies that, in that context, that are able to acquire. Just sort of, speculating here, but potentially why you see that happening is because there are a higher number of large companies that can acquire smaller companies in other places versus the markets that you're talking about tend to be dominated by SGDs.
Yep.
So, maybe one way to look at it is we'd rather keep growing the company than have it acquired if the goal is to create and maintain wealth locally.
Right. Yeah. At the risk of speaking for Laura, since the answer piping up directly, I think a part of it is going to the Clara Miller-Heron point that a portfolio of impact investments is not just like a basket where you have all these beautiful fruits that get taken out one by one. So I think Laura was getting to this idea that what is best for that one company, because it can continue to grow, because that was the perfect acquirer, is still not accounting for what is the effect on the broader ecosystem, not just in terms of that company's stakeholders, but really the ecosystem of early stage companies. So just something to put out there.
Yeah, great.
Terrific. We're almost up with time. I was wondering if there are any other questions, or in particular whether Anna and Chuck wanted to make any remarks at the end of this conversation, or of course Hannah and Hannah.
Nope. I think we're good. It's been a really interesting discussion, and so I'm really appreciative of the opportunity to get into some dialogue with you and with everybody on the line. Great.
Well, thank you so much, all of you, for joining us. Contact information is here. If you're interested in the work of the Transform Finance Investor Network, you can contact my colleague Kurt Lyon, kurt@transformfinance.org, and we'll probably be putting out a write-up of some of the discussion that has happened here. Thank you so much, Hannah and Hannah, for that for the report that you issued. Thank you for joining us on the conversation today. Anna, Chuck, thank you also for coming and telling us a bit about the work of Grassroots Capital Management and of InvestEco. Very cool stuff.
Thanks.
Thanks, everyone.
Thank you, everyone. See you next time.
Bye. Thank you.
Thanks.